Hello, welcome to Any Answers Answered for June 2018. Another 2 questions from the Any Answers pages that Tim and I have had a look at, and hopefully useful to both the person who asked the question and everybody else as well. We start with a question from Mike Soul, who has a question relating to Cycle to Work scheme. And the basic point of his question is that most people seem to think there's a £1,000 limit in the Cycle to Work scheme, when in fact he can't find any such rule. He's saying, could I just go ahead and have a bike with £2,000? Would I be able to get all the benefits from that?
Yes, and it's an interesting question because the £1,000 is quite widely viewed as the upper limit for the cost of a bike and the associated safety equipment that an employer can provide as a tax-exempt benefit. And ordinarily, where an employer operates a Cycle to Work scheme, they'll be offering employees the opportunity to use a bicycle owned by the employer. And the reason for the £1,000 limit is that this is viewed as a hire agreement, H-I-R-E, and is therefore governed by the Consumer Credit Act. And unless the employer has a consumer credit license, which they might, the Office of Fair Trading, the OFT, have said that there is a limit of £1,000 on the amount of value of arrangements like this that can be offered by employers without such a consumer credit license. But it's not an HMRC limit, and certainly if the employer had a consumer credit license, there is no upper limit, so £2,000 would indeed be perfectly acceptable. These days it's not unusual to find bikes for sale that cost £5,000, and these are not even electric bikes. But it does raise an interesting question. Suppose that you've got, and indeed the answers on the accounting website, there are only 4 comments, but basically confirming yes, Portionine 11 comes in and says you are correct, and then Tax Dragon says if e-cycle is short for EAPC, I agree. I'm not sure what EAPC stands for, I've not looked it up, but I loved Portionine 11's further comment, which was, how can a longer term be short for a shorter term? Which reminds me of something I've said in the past about how only we in the United Kingdom, who of course invented the World Wide Web, could in fact abbreviate it to an abbreviation that is longer in terms of number of syllables than the original, because www is longer than World Wide Web. Anyway, I digress. Getting back to the tax point, suppose you're a one-man or one-woman company. Can you, through the company, provide yourself with a bike under the Cycle to Work scheme that costs, say, £2,000 or £3,000? Well, I don't see why not. And as long as you meet the primary condition, which is that the bicycle is used primarily for commuting to work, that's an important point, which is often overlooked, then is the one-man company actually hiring it to you? If it's owning the asset and letting you use it, I don't really see how that falls under the Consumer Credit Act at all. So I think that £1,000, and in any event, not that I would encourage or endorse such behaviour, but frankly, what are the chances of anybody being taken to court by anybody else for breaching that 1,000 limit? I think very slim indeed.
And the point is that if there is no obligation for it to be hired, some people think that you have to hire it, but in fact you can just make it available to an employee.
And what it's doing is avoiding the 20% annual value charge that would otherwise apply.
A very useful benefit. Also a benefit that we can still salary sacrifice after the introduction of optional remuneration arrangements.
Indeed, because it's exempt from the optional remuneration arrangement rules, quite right.
So worth pointing that out too. Our second question this month is from Paul Hawes, who has a question about the employment allowance. The legislation for the national insurance allowance says that connected companies at the beginning of a tax year cannot claim multiple lots of the allowance. Does this mean if a director of a company sets up another company during the tax year, that the new company can still claim the allowance in the tax year the company is set up?
It does mean exactly that. Now, as the questioner identifies, the employment allowance of £3,000 that reduces the employer's liability to secondary class 1 is only available to one of a number of companies under common control. And the definition of common control is a hangover from the old small profits rate days, the associated company rules. However, that definition is disregarded, or at least the impact of it is disregarded, if there is no substantial interdependence between the companies. Take our software company, which has 3 shareholders, of which you and I are 2, and our training company, which has 5 shareholders, again you and I are 2, and you and I are partners in the professional training partnership. Well, those 2 companies do indeed fall under common control. So in the first instance, we would say that only one of the 2 can claim the £3,000 employment allowance. However, we don't need to do that if there is no substantial interdependence between the 2 of them. And I think we long ago agreed that there probably wasn't any substantial interdependence between the 2. And then a further point, what about a partnership and a limited company where, let's say, husband and wife, to keep it very simple, are in partnership, but they also have a limited company that they jointly own? Well, there, the common control rule doesn't apply, and they would each, as employers, if they have separate payrolls, be eligible for that £3,000 employment allowance. So a useful reminder of how the employment allowance rules operate where you've got more than one business, as it were, and it does depend on whether the businesses are incorporated or unincorporated, but the basic question is that we determine the control and whether you have to take into account other companies at the start of each tax year. And so if this director sets up a new company partway through the year, it won't be until the following 6th of April that we'll have to decide which of his companies can qualify for the employment allowance.
But presumably he would get the allowance for that first period. It would only be the second year when they had to double check.
Exactly. So in the year in which the new company is formed, it won't affect the existing company's entitlement, and the new company for the remainder of that year will be entitled. But from the following 6th of April, they'll have to decide which of them gets it.
Okay. For an area of tax that we all thought was extremely simple when it came in, and it is relatively simple, it's amazing how many questions crop up about this £3,000 allowance. Do make sure you're claiming it correctly. And do join us again for another set of questions on Any Answer Answered. But for this month, bye-bye.